Hello, welcome to the podcast today, which is the first day of summer, June 22nd, 2026. Happy summer, everybody. Today, the podcast this month is going to be on private money. And as you may have seen in some of the Facebook posts and some of the Instagram, what have you, we're going to talk about private money loans. And what are private money loans? Private money loans are those loans that if you're thinking about doing a fix or flip, or maybe you can't qualify for traditional lending and you're having trouble. Well, there are individuals out there who will lend their money. This is their money, not the bank. You don't have to go through a normal application process in many instances, but they will lend their individual money for your project and put a lien on that property. So we're going to talk about what is a private money loan. Sometimes they're called hard money loans. What's it take to qualify for a private money loan? How to calculate the payment. And we're also going to talk a little bit about cross-collateral loans. We're lucky to have as one of the folks in Counsel Mortgage here, Alan Powell, who's been in the private money business for how long, Alan? How long have you
Uh,
been in the
just over 20 years.
He's too young to be in the business for over 20 years. So he's been in for a little over 20 years, and I've known him all that time, actually. So Alan has a nice presentation that he's done to real estate offices. So if there's some real estate offices out there that are interested, contact us, and he'd be happy to come to your office to explain hard money loans and private money loans, where you can help a lot of your clients acquire the property so they can fix and flip it or keep it and rent it out or however it is they want to do. So, Alan, do you want to take it over from there?
Yeah. Well, thank you, John. I appreciate it. Again, my name's Alan Powell, Alan Powell, and I moved here about 22 years ago from Southern California, and was originating loans originally in Southern California, but got into doing private hard money loans here for now over 20 years. And what the thing John said again, what private money loans are is that you have a private individual. Now, you do have some big, larger corporate banks doing some hard money lending, but most of it generally is done by private individuals. And those private individuals are investing their money into what's called investing in trust deeds, is what they're doing. And the advantage to that is that it's a very secured instrument of lending for these different investors that they feel it's safe. It's I categorize I compare it to investing in gold. You have something real and tangible that you're actually lending money on, and that's the investment that it's protected by. And the way it's secured by a trust deed, and that's what they're investing in. It's called investing in trust deeds, and you have a promissory note, and the trust deed is what's recorded through your county records. And so the investors are feel that that's a very safe return on investment. Investors are charging anywhere from 9 to 13% interest rates, and so the return on their investment is sometimes better than the stock market. And so that's why they feel it's pretty safe to work with. The other advantage for the borrower is that they actually have a personal relationship with the lender. They get to meet the lender, shake their hand, greet them at the properties, and they actually have somebody real that they're talking to, as opposed to a corporate office where they're just a number and they have to call an 800 number to get any help. So that's another advantage to a borrower, is that they're actually dealing with somebody real and personal that they can have a long-term relationship with and be able to do these loans over and over and again, depending on what properties they're buying for their portfolio. And so private money has been around a long time. It's called also hard money lending as well. It's been around for years. And it's a very attractive instrument or a tool to use when, let's say, a borrower necessarily can't qualify through conventional lending. Now, the myth is that over time it's been, oh, it's only but somebody with bad credit that's doing private loans, and that's far from it. I'd say 65% of my business that I work with clients, they have 700, 800 FICO scores. The issue with a lot of these borrowers who are actually coming to using hard money tends to be they're making great income, but some of it's cash, or some of it's they want to write off everything for tax purposes, and it becomes a debt ratio issue. And those are the borrowers that tend to use private hard money, is that we don't take tax returns, we don't use pay stubs, we don't use bank statements to qualify a particular borrower. On the application, it's actually done as a stated income. And so that's how we do our loans, is they're going to state their income, and we don't actually look into the verification of that income through bank statements or tax returns. So the big thing is now they're not having to qualify for a debt ratio. And so I tell people that we don't qualify the borrower, we qualify the property. And so the property is going to be key in any hard money or private loan that's done, is by valuation. And what is the borrower buying the property for how much? Or if we're doing a refinance of a property, is what the valuation is through comping. The advantage to also hard money with us is that we don't do appraisals, and the cost of an appraisal is not necessary. Especially comes into factors when we also do not only residential homes and single family homes, manufactured homes, or mixed use properties. We do is commercial. And knowing Jim, commercial appraisals tend to be very expensive, and we actually don't require commercial appraisals either. So that could save a borrower if they're buying a commercial property or refinancing a commercial property to pull cash out to buy a residential home. They could be buying using a commercial property. We do a refi for them, and they might be paying cash for that property that they're buying. And it can be a homeowner, owner occupied property if they're pulling cash out of a different property and paying cash for that owner occupied. So there's with individuals that are coming to us, generally, we have pretty much three types of individuals that come to me for private loans. They're more people in the mortgage industry, loan officers who don't have the access to private lending, and they want to service their clients and provide a loan for those clients that are loan officers or mortgage brokers. We have real estate agents who are working with their clients who are either selling properties, and they have they're representing the seller, and then they actually find a buyer who needs to buy that property, who needs to go through private money, or they're representing the buyer directly. And then you have private individuals that come to me that tend to be investors who are buying fix and flip properties or rental properties. The bulk of most private hard money loans are done for the borrowers who are doing fix and flips and buying rental properties. There's also, you can also use private hard money to refinance a property. And as long as the money is used for business purpose, they might be buying trucks for their business, manufacturing equipment, inventory, and they can also use private hard money to finance take a loan out on a property they may own in their portfolio. So there's the industry tends to lean a little bit more towards the investment properties that are fix and flip. Okay. Our loans that we tend to do are 2-year terms, and we write them up for 2 years, even though it might be a short-term loan that the borrower needs. There's a 90-day interest guarantee, and that means that the borrower, after paying after 90 days, doesn't owe any prepayment penalty. If they do pay off within the 90 days, prior to 90 days, it's prorated. So it could be small amount. If they pay us off in 2 months and 28 days, you just figure out what the daily interest payment is, and they would owe us only 2 days of interest. If they paid us off in 2 months, then it would be 30 days of interest. Now, all these loans are not amortized. They are interest-only payments. And I'd like John to throw up the first slide here on what is an interest-only payment. Now, some of our viewers are very familiar with how to calculate an interest-only, but some may not. And I wanted to go over the quick formula on how to calculate an interest-only payment. Okay. And so you don't need a mortgage calculator for this. You just use a regular calculator. And so here in this example, we have a loan amount of 165 and an interest rate of 9%. Now in this formula, you could plug in 10% interest, you could plug in 12% interest, 13% interest, whatever interest rate you're getting quoted at. It's an easy calculation by just taking the loan amount and times the interest rate equals the yearly rate. And you'll see here that here's the interest payment for the year. You're going to divide by 12 months, and that's going to get you your monthly payment. So it's a very simple formula. Loan amount times interest rate equals the year, divide by 12 equals the monthly payment. So when you're shopping around, or a client is shopping around, or a loan officer shopping around for hard money lending, they could just ask, easy question, ask the lender, what's your interest rate? And if you know what the loan amount is, you can calculate that monthly payment very simply. So that's the advantage also with doing these types of loans, is that the borrower is only paying an interest-only payment, which allows them to qualify for more property. They're not doing an amortized loan where the payment would be higher. And so now they're finding themselves to be able to afford more expensive properties because they're only making that monthly interest payment. Now, mind you, nothing's going to principal. There is a balloon payment at the end of the 2 years. So either the borrower is going to refinance into a conventional loan, sell the property, or refinance again in another 2-year period for a hard money loan. And we have lots of clients who keep continually refinancing their loans over and over again. And that's the advantage to the loan officers, that they're also making commissions every time it's refinanced. And so that's an advantage with it, with a loan officer who has this tool to provide for their clients in giving them more options for lending. So when we talk about borrowers also qualifying for loans, and you can take that screen down, the interest only screen down, is that another thing about borrowers is that when it comes to employment, we don't look at a borrower's employment at all. We don't do employment verification. A lot of these borrowers are self-employed anyways, but we don't have those problems with conventional lending, which occur when you don't have 2 years of work history. Or one nightmare I had was a borrower in the process of a conventional loan decided to quit their job in the middle of the processing of the loan, and then they got denied because they didn't keep their job. And so we're not going to be concerned with that. So we also work with foreign nationals from Canada and from Mexico. They're not required to even have a social security number, a TIN number. A passport is just all they need. And for us, they do need to sign documents in the United States, is only the requirement with foreign nationals. So we have people who living in Mexico who are buying properties in Tucson and in Nogales and in Rio Rico for their family members or as rental properties. And they just have to come across the border and sign documents in a title office within the United States. So that's an advantage to there on that type of borrower, which comes up every so often. And there again is a client that both real estate agents will find themselves who have clients who are trying to buy properties in Arizona, or loan officers working with clients that live out of the country that take advantage of the private hard money because it's much more easier to qualify than conventional lending. Then we get into uh, what I want to call types of properties that are typically bought through private hard money. And those, like I said, are investment properties. They tend to be what I would call a little on the depressed side. They will need quite a bit of work. You see, there's TV shows all the time on rehabbing properties. Those are the types of properties we seem to see in the private hard money world. I do inspections of properties quite often and go into and seeing some of these rundown properties, but it's miracles of what the investor who's doing fix and flips that can rehab a property and turn into a gem and actually make a good return on their investment from buying these properties at a lower price point and then reselling them at a much higher price point because of the rehab that's done. I've been in one property I went into, and it was the looked like it had been a squatter had lived there. There was paint, spray painting, graffiti all over inside. The walls kicked in. I walked into the kitchen, and I started hearing this humming noise, and it ended up there was a full size beehive inside the kitchen. And I walked out of there thinking, oh wow, I don't know if this is going to be a tough one, but my lender said, no problems. We know they're getting it at a good price, and they're willing to do the work in rehabbing these properties and putting them back on the market. And so even though it might be a short term that, on a loan that a borrower will do is maybe, purchase a property, the time it takes to close, and then rehabbing the property may take anywhere from 2 to 3 months. You don't see the interest guarantee really that much coming into play at all in hard money lending, because the time it takes to rehab the property and to get it on the market and sell the property covers that first 90 days anyways. So the return on investment, that's what's key on with any of these borrowers, is they do need to look at the cost of the loan, the payment of the loan at a higher interest rate than, let's say, a conventional loan at 6%. You're looking at a loan that's more like 9 to 10% on the payment. So they do need to take an account of when they do spend the money for the remodeling and the rehab, and what is going to be their return on investment on each property that they happen to buy. So but it could be also a borrower with the market right now for rental properties is still extremely high. And what people are getting per square foot on rental properties, being a single family residence, or it might be a commercial property as well, is that even if they have a hard money loan for 2 years and they're making a higher payment on interest rate, that they're still cash flowing on the property due to the rental market's costs are much higher. The rents are much higher. And so that's an advantage to some buyers who are buying multiple properties, be it a fourplex, sixplex, multi-unit, 10-unit apartment complexes. And we've done hard money loans on 10 and 12-unit complexes. And so those are cash cows for some of these buyers. Especially, you'll find that there's certain apartment complexes that are set up for, and I'm having a blank, sorry, John, for Section 8 properties. And so because those are attractive properties, because the government is guaranteeing the rents on those properties, we're seeing investors buying those types of small 12-unit, 10-unit type apartment complex, 8-unit apartment complexes that are being utilized for Section 8 housing. And so that can be a big advantage to an investor. And hard money is a great way to use for that investor to borrow with, use that money to buy those types of properties. And so we'll see those types of properties come up on every so often. Um, the other thing that we find is that becomes problematic sometimes with certain properties is condos. And condos do have required what's called a condo certification. And what that certification is really a questionnaire that the condo association provides any lender for answering certain questions that are required by the lender. One of the ones that questions that come up quite often is it a non-warrantable condo? And a non-warrantable condo is a condo that can be where you might, and you see this more often with 10, 20 unit type complexes, where if 60% of those owners that own the condos are non-owner. They are not living on those condos. They're non-owner. They might be living out of state and they own these different condos. That becomes a non-warrantable condo. Some lenders do not loan on non-warrantable condos because of the higher investment percentage of ownership within that condo complex. We do not even take a condo certification. We don't require it. It's something we don't even look at. The other issue could be that a condo might have because of their community grounds. Let's say somebody slipped and fall by the pool and they're filing a lawsuit against that condo association. Conventional lending won't tend to lend on those properties as well because of the pending lawsuit that might be on that property. Again, because we're not doing the condo certification, we're not worried about that there's a pending lawsuit on the association itself. So
Alan,
there's
Alan, you may be starting to see a little bit more in this area because FHFA has put out guidelines for Fannie and Freddie to even tighten condo
so
lending guidelines. Instead
right.
of having 10% in reserves, they're going to increase it up to 15%. And there's some
Okay.
other things that they're going to be making even tighter for condos. So private money you may start seeing more and more private money in condo acquisitions.
And that's great for your real estate agents, you know, by for loan officers being able to approach real estate agents and offer a private lending option for them in order to play, you know, to be able to place a client of theirs in a condo. And the idea here is that your loan officers are servicing the real estate agents to try to help them make more money at the end of the year in commissions. And this is an extra tool that's so vital to real estate agents that they may not do only maybe one or two hard money deals in a year, but if they're making 20,000 on 10,000 a sale, that's a pretty good chunk for their commission in their yearly income.
Yeah, and
So
it's good for the buyer too, because they're able to get a condo that they otherwise would not have been able to get.
yeah, correct. Uh, so you'll find also uh, okay, when going back here now to talk about loan to values, okay, because I actually missed that part, is tendencies that the rule that we have in the industry is with the borrowers is what we call skin to the game. How much money are they actually putting down into the property? It tends to be with hard money lending is that the loan to value of the property is going to be anywhere from 70 to 75%. So they're going to either come in with 25% down, or they can have different options to be able to cover that down payment. Is one, seller carrybacks, and that's where the seller can do a secondary loan behind the first up to 15%. So we're looking at if we do 70% of the loan and now we're doing 85, the borrower's coming in with maybe 15%. You know, we'll even allow up to 90% where we do 70 and the seller's carrying back 20%. So long as the borrower is bringing in 10%, and they have some skin to the game, then that's how we accomplish these types of loans. The getting into another way of borrowing and providing a loan for a borrower without them coming. Some of the questions I get, I get borrowers asking me, because, how can I do 100% financing, and I need you to pay for the rehab of the property, can I get loan on that too? I want to put 50,000 into the property. Okay. Well, that tool that we use within the hard money, private money world is called cross-collateralizing. And what we do is we look at probably the number one question we're going to always ask the borrower is, what is your schedule of real estate? Okay. And again, we're underwriting the borrower's properties as opposed to their financial situation through bank statements. So we're going to take a look at each property they may own. And you may have a borrower who owns a couple rental properties. And let's say they want to purchase a property, but they don't want to come in with any money down. And they also need the rehab costs as well. And so we'll take a look at that other property and we discover, wow, that's a free and clear property and it has a lot of value to it. And what we'll end up doing is we call cross-collateralizing the properties together. So we're going to have property one and property two is going to be on one trust deed. Both properties are together and listed on the trust deed and on the promissory note. And then it's one payment for the borrower. We're not doing two separate loans. We're doing one loan. And that by doing that, that also saves the borrower a little bit money on closing costs and some fees. Now, there is requirements, again, when we talk about underwriting the property, is that our biggest key is that we do have lender insurance, title insurance policy. And what we're looking for is clean title that doesn't have any, it could have some liens, collection stuff, small collection liens, but generally we're looking at clean title on the property. So again, we're underwriting the property. And if we do have two properties that we're doing a loan on both properties, we're going to be pulling title reports on both of those properties and having lender policies for that. And that's where the borrower does pay for those. Okay. So I wanted to bring up an example of cross-collateralizing. And if John wants to pull up an example of that. Okay. So we have property one is a purchase, and the purchase price or value of that property is $300,000. We're going to have a loan to value. The lender is willing to do 70% of that value of that purchase property. And now we have a $210,000 loan amount. Well, the purchase is $300,000. Where are we coming up with the other $90,000? And they also want at least $80,000 to be able to cover closing costs and during the rehab of the property. So where do we get that money from? And they say, well, I don't have that reserve type money in my pocket. The borrowers will say that. And how can I get 100% financing? Well, we find out through their schedule of real estate that they own another property. So we have property two that we treat as a refinance, and we combine the two properties under one trust deed. And then we find the value of that property being $250,000 value. We're doing a 70% loan to value on that as well. So now we come up with the cash equity out of that property that we can do the loan for is $175,000. We combine those two loan amounts together and we come up with $385,000 as a new loan amount. This covers the purchase of the $300,000 and then gives the borrower an additional $85,000 for loan costs and rehab costs. So again, we have one loan, one payment at interest only. And by combining both properties as cross-collateralizing and securing them both on the trust deed, that way the borrower can utilize their other properties that they have, their other portfolio of properties, and utilize that money that's just sitting on that property that's not being utilized in order to be able to use that to buy an additional investment property that they're looking to purchase. So this is a great way of doing that. And so you can actually do another combination where this is a great story for a real estate agent of mine who was able to close 2 different purchases within about a 5-week period and make commission checks on those both purchases. And what the client was again, it was a client who happened to have a maid service business. She gets paid cash only, so she's not qualifying through conventional lending. And she owns 7 other properties. And we discovered that she had 2 properties that were free and clear. The client wanted to buy this first initial another investment property. The real estate agent who brought me this client had the client. He goes, I have this property she wants to buy. And we discovered that she had 2 properties that were free and clear. So we cross-collateral those 2 properties and took all the cash out of those properties so she can pay cash for the purchase property. So we're not even tying up that purchase property. We're utilizing her other portfolio properties to buy a property, but pulling all the cash out of those 2 properties as a refinance, but cross-collateralizing them again on one trustee. So after we closed in about 10 working days on that property. About 4 days later, that same real estate agent came back to me and said, hey, this borrower found another property she wants to buy. And again, she doesn't have any money to put down for down payment or rehab costs. And we found that, okay, well, you just bought this property for, let's say 300,000 was the amount, I believe. And that's free and clear. We just closed 10 days ago. And it was a free and clear property just sitting there for her as to utilize the equity in that property. And the other purchase property she wanted to buy. So we cross-collateral that brand new purchase property she had to the new purchase property she's buying and combine those 2 again. And we closed that in about 10 working days and being able to help the client being able to buy 2 properties within a month and without putting any money down for down payment, for closing costs, for rehab money, by her utilizing her equities in these different properties. And the best part was that real estate agent made 2 commission checks on a borrower that could not get conventional lending whatsoever. And that real estate agent was so happy with the service to be able to have that ability to be able to close these deals that normally can't go through conventional lending.
And those are also known as bridge loans too, right, Alan?
Yeah, they can be considered kind of the old school name of it was bridge loans as well. Private investing is pretty much the new term. So utilizing that tool as a hard money to get your clients, not only your direct clients that are borrowers, but helping out your real estate agents making additional commission checks in the year that normally they wouldn't be able to close because the borrower didn't have conventional financing available to them. Getting into a few other things here, other properties that tend to come up is mixed use properties. And some people may not know what a mixed use property is. An example of a typical mixed use property, and you see them dotted around in Phoenix and Maricopa County and things like that. And they are properties that you'll have one parcel, but you'll have a residential home, let's say, on it. And these might be homes built in the 50s, 40s, and the 50s and the 60s. And because there was no real HOA regulations in these types of neighborhoods, and they were more rural type properties to begin with, but now with the big expansion of residential neighborhoods, these these homes tend to be surrounded by new build homes, and they'll be in kind of an island within Metro Phoenix, and they'll have what's a cinder block building on the property on that parcel. And so you might have the owner who owns that property um, renting the house out for one rent amount, but they're also renting out that cinder block building that has a business in it. Be it, I've seen cabinetry shops, I've seen trucking guys with trucking companies and different things having their businesses on that property. But you have a mixed use. You have a commercial usage and you have a residential usage here on this same property. And this type of mixed use property tends to have problems getting conventional lending. And here again, hard money steps in, private loan will step in, and we look at it as great. This property is generating two incomes, and there's value to that property, more value, more so than a regular rental property, because you have two different rental incomes and two different uses with that property. And we don't have an issue with doing those types of mixed use properties. Again, another tool for loan officers to utilize for their clients or their real estate agents that they have as clients themselves. When we get into another big world of property that are being bought is manufactured homes, manufactured housing. And that is a interesting part of the business, is that we do loans on manufactured houses. And that can be problematic with certain lenders in doing manufactured housing. Now, we don't do loans that are, we only do loans post 1978. So anything before 1978 becomes a problem because it's they tend to be unfinanceable on those type of properties. But we see a lot of business coming from borrowers who are buying properties. One of the big things is that you have areas like Tonopah, which have no HOA regulations or anything in Tonopah. That these manufactured homes are sitting on 2-acre properties, and we see surprisingly quite a few people who are buying these properties who are truckers, and they love to buy these properties because they can park their semi and trailer right on the property land there, and have that manufactured home on the property for them to stay between as they're going from cross country to cross country. They're finding Arizona is a great stopover point for them when they're driving, and they're buying these properties that allow them to park their truck on and also have a home to stay on for a couple days for their rest period before they start traveling again. So we're seeing properties like that as well. So manufactured homes, depending on condition, single wides, double wides, triple wides. We don't have a problem with doing any of those types of properties. LTVs tend to be maybe a little bit more towards the 65 to 70%. We won't generally do higher than 70%. But long as the property is attached and we have a certification of attachment, that manufactured home to the parcel, then we don't have a problem with doing those types of loans. So the multiple reasons, like I said, to do properties. When we get into commercial, we've done hotels, small hotels. I had one small little 15 unit hotel that was on Lower Buckeye around 19th Avenue. And it actually had a sign in front of it that said, we have hourly rates. And so we didn't care the usage of that hotel, but motel, but it had value. It had, and so we were able to determine a loan on that type of property. So doing, I've done one of the big, one of the lendings that we do on properties is you'll see residential homes that have been converted to zone C3. So you'll see those properties like classic is when you're driving down 24th Street south of Camelback. If you look up and down that street, you'll see all these private homes that are now lawyers' offices, real estate offices, tattoo parlors, glass tinning businesses. It might be all types of different businesses. And these are residential homes that have now been converted into commercial. And we're more than happy to do those types of loans. And those types of borrowers tend to be needing private hard money to purchase those properties because they're starting out their business. They're new in the business maybe, and they're looking for a cheap or commercial property instead of getting into a regular size, let's say, industrial condo suite or a regular standalone commercial building. They're utilizing these types of residential homes that are now being converted into commercial usage. And those are great for us. Their commercial valuations are very good. And so we are more than happy to loan on those types of properties as well. So we see multiple reasons that a borrower is using hard money. It's not because they have bad credit. It could be a property issue that they're looking to buy something or refinance a property and utilize that money to buy other properties as well. And so having private hard money as that extra tool in your toolbox to be able to get more loans, servicing your clients and being able to help them achieve their goals in investing in real estate or utilizing their money to be able to utilizing a property to be able to pull equity out and pay for expenses for the business. And so that's a great tool is private hard money. And so the advantage too is that we don't have the paperwork involved in a conventional loan. We have a simple 3-page conventional commercial loan application with a couple disclosures. One of the biggest ones is it's called business purpose disclosure. And that is just stating that the borrower is doing a business purpose loan. And that's how we look at non-owner properties as they're commercial properties. Even though they're a single family residence, it is considered a commercial property. So I hope I was able to help people out here in answering some basic questions about what is private hard money. It's an excellent tool to utilize when you can't qualify through normal conventional financing. The rates are not too unreasonable, and which is pretty nice about also private hard money. And the process is pretty simple. Like I said, that we're closing loans in generally about 10 working days, 8 to 10 working days. And so the speed of being able to help a borrower close when it's quick, it might be pressure from the seller trying to sell fast. It might be pressure from the borrower that needs to buy fast. And it helps that real estate agent close deals fast and provide great service for those borrowers. And that's the key, is to provide great service for a real estate agent. We see loan officers who try to get more business out of a particular real estate office and has troubles doing that, but they end up closing a hard money loan for a real estate agent. That real estate agent was so happy to make that extra commission check that they're referring that loan officer to other real estate agents within that office. And it just balloons from that, all because they were able to get a loan that couldn't go through conventional financing and was able to do it through hard money. And that loan officer now has that foot in the door with that broker, real estate broker in that office to be able to get more conventional lending referrals from them as well. So it can be a real great tool for loan officers to utilize in order to get that extra business from real estate agents that we depend on. So, is anybody have any questions that you might be thinking about?
Well, Alan, that was a great presentation, by the way. And those are excellent
Thank you.
points. When people look at a property and they're like, oh, gee, my credit, or, oh, this property is in such disrepair, I'm never going to get a loan. All is not lost. There are still ways to finance and try to get the property. And Alan just gave a great background on private money loans. I mean, there are so many different ways to get financing out there. And I like to say, because all the people here on the panel have been in this business for a while, and having lived through cycles, it seems like when the rates go a little bit higher, you see more and more products come out, and there's so many products available. And here's just some of them here: private money loans. And private money loans, yeah, it's a lot more simpler process because you're dealing with an individual. You're not dealing with a credit committee. You're not dealing with a bank. You're not dealing with Fannie Mae or Freddie Mac regulations. You're dealing with an individual. And is that individual wanting to lend with you? Like Alan said in the beginning, you're going to develop a relationship with this person.
Yeah.
You'll get to know this person in many instances because the individuals actually go to the properties and visit the properties and talk to you before they even decide to lend their money. Anything else you want to add to that, Alan? I know you've seen a lot of properties.
It's the investor lenders I work with. I've seen them where I've been together with the lender and we're looking at the property and I'm going, oh, I don't know if that lender's going to do it. And he starts talking to the borrower and he goes, I just love this borrower. I want to help them out. And I think I'm definitely not going to lose money here. And it can be done just from a good, warm feeling from that borrower. And in fact, one of them, we were there at the property, and after Jeff said, "Yeah, we'll do the loan," they invited us for lunch, and we got a wonderful home cooked lunch from the wife, and it was like an amazing experience. And it was all from just a good feeling that the lender got from the borrower saying, "Yes, we'll go ahead." And this was a property in Maricopa. It was a ranch style house that was kind of in disrepair, but it was sitting on 10 acres as well. So it was a small farm. And that was why the lender that we worked with just had a great warm feeling from the borrower. So you get that type of good relationship, long-term relationship with some of my clients that keep coming back because they know where we're talking about. We're fair and we're easy to work with, and it's just and reliable to come up with the money that they need to do whatever project they're working on, be it buying a rental property, be it a fix and flip, or like I said before, with commercial properties, or with just pulling cash out for their businesses and needing cash to take care of expenses that they might incur. So
looks like you have a couple questions here. Mike may have a
yeah.
question. Mike, you have a question or anything you want to say?
I do. If I could get just a couple quick ones.
Yep.
Alan, do you require phase one environmental site assessments on your commercial properties?
No, we don't, but the lender does look at properties and will determine because we've looked at quite a few properties where it'll be something near downtown Phoenix, Metro Phoenix, South Phoenix areas, where a commercial property might have 100 wrecked cars. They were, all these different cars that were parked on the property that might be leaking oil and gasoline on the property. We'll tend not to do those properties because of environmental, and we don't really get into the issues of doing phase one, right? You would know better, Jim. Is it phase one or phase three
Mike.
on environmental?
Phase one.
Mike.
Phase one, right? Phase one. Okay. And so the cost to do those and then determine that came back, yeah, they do have problems, and we'll decline that loan because of the environmental. We just kind of pretty much tell the borrowers we just will pass on those types of loans. But we've had certain borrowers doing loans. We did one on a commercial property that they had a pest control business running out of it. They were leasing the property before they'd been leasing for 10 years, running their pest control, storing their pesticides in the property. We didn't have an issue with that one because the lender thought that the person was doing things responsible, and they didn't have an issue with the fact that we would call environmental in to check to see if there was contamination from the chemicals. So it depends. It's case by case basis on each property.
Your 70 to 75% LTV, is that for both commercial and residential?
It can be on both commercial and residential. Commercial is a little bit more difficult to work on, is because we don't do a commercial appraisal. The lenders are having to do a little bit more research, and they do consider the market on commercial properties as well, and what's going on commercial properties and valuations right now. Is commercial property a little bit more level and not going down or going up at all. So there has to be considerations on that. But yeah, we've done 75% on commercial properties.
Okay. You do out-of-state properties outside of Arizona?
No, we're only licensed for Arizona. So we just do the state of Arizona. Plus, we touch every property. That's the rule. Is every property actually has to be physically visited by either myself or by the lender personally. And it's travel costs, it's time. We do properties in Lake Havasu, Quartzsite, done Flagstaff, Payson, Show Low, and we have to drive to those properties. Rio Rico, we've done properties as far south in Nogales, as far south there. Yuma, we do quite a bit. Surprisingly, we do quite a bit of business in Yuma as well. And so those in commercial property, we've done commercial properties in Yuma. And so it's the inspection time. We don't charge for that. And so when we want to stay within the state of Arizona.
Now, I just want to jump in here and say that's at least Alan's piece of it. Counsel Mortgage, though, can do private money loans throughout the country. So if you are considering doing a private money loan on a commercial business in a state other than Arizona, that is something we may be able to help you with. Go ahead, Mike.
Just an observation here on rates, if I share this with you.
Yeah.
Prime today is at 6 3/4, right?
That's right.
Looking at SBA loans for a minute, their maximum loan markup to prime is 2 3/4.
Oh.
So for a 7A loan, the maximum the lender would charge might be, looks like 9.5%. Okay. Realistically, I've been able to get those out at prime plus maybe 2 to 2 1/4. So if you plug that in, an SBA qualified lender in property would be giving a quote from their lender at 8 3/4 to 9.5%. That isn't a whole lot different than getting to your 9 to 10%. And as I say, this is just an observation on rates.
Correct, Jim. I have one investor, depending on it. Now, again, it's going to be depending on the property. If it's a nice single family resident property there's not a lot of rehab required to it. It's recently, let's say it's a house that's within 10 or 15 years built in a nice community. He's doing loans as low as 9%. Typically right now, for the really stuff that needs to be rehabbed, manufactured homes, and commercial properties, we're going to be at closer to 11%. So it could be anywhere from 10.5 to 11% on, but it's case by case again by the lender just inspecting the property and deciding what interest rate that's going to be. So
Well, I
it
think
is subjective when it comes to the rate. So
I think from my desk, as I look at this, because a lot of it is the terms. Everybody gets wound up about the rate. What's the rate? What's
Yeah.
the rate? What's the rate? And we calculate the rate. But what it really gets down to when you get past that is what are the terms?
yeah,
And I think that, with your background and knowledge into private and perhaps my experience into SBA, there's a lot of direction to tailor the loan, whether it's an SBA or private, doesn't matter to us, right?
Mhm.
To tailor it for the very nitty gritty of that term and condition, which has so much to do with it, the prepays and whatnot. I mean, there's all kinds of things. What about the qualification package itself?
Yeah.
Because if you do an SBA, you're going to have an appraisal and you're going to have a phase one, and you're going to have other things qualifying, documents and the taxes and what have you.
Mike, plus the other advantage is how long does an SBA loan take to close? Whereas one of these private money deals, we can close in 10 days.
Well, as they say, if the terminology, which has so much to do with the borrower's reception of it,
yeah,
it's called a bridge loan and not a hard money loan. That's a whole lot different. It's the same loan, but it's what you call it.
yeah.
And bridge
Now,
loans
the
are
terminology for a bridge loan in commercial is different than what it is in residential when we talked about cross-collateral loan.
Well, no,
What are you talking about bridge loan in commercial? Just give a little explanation on that, Mike.
Yeah, but again, it's presentation and terminology, because so much of what the borrower hears is not what we say, but they're interpreting and implying what we say.
Yeah.
So if I say, gee, I'm going to get a hard money loan for you here, they're thinking, oh my God, 14, 15%.
Yeah.
But if I got a really nice bridge loan that'll close in a couple of weeks without all of the rigmarole to get to it, and here's the bailout,
Yeah.
because that's what a lot of people that I talk to, everybody's interested in getting into the loan.
Mhm.
They don't give a whole lot of consideration to how I get out of it. When does this terminate? When do I, they see a 25-year amortization and they think, oh, I'm going to be out here 25 years. Well, they don't go that long.
Yeah.
I've been doing these, 25, 30 years now, John, not just with you, but out here. I've had one SBA loan that went the full term.
Mhm.
Not 25 years, because they did a lot of prepays along the way.
Yeah.
But they held that to pay it off, I think, in 7 or 8 years.
Yeah.
The rest of them never go.
Yeah.
25
Clay also has a question. Oh, Clay has a question here too. But before we get to Clay, real quick, that gets to a point that
John, let me
that gets to a
interrupt.
point that we need to talk about that we didn't talk about on hard money is exit strategy. So maybe
Yeah.
you want to talk about that too, because that's as much of a part of a private money loan.
Okay, well, let me go back to something that you kind of pointed on as a bridge loan per se. Hard money is looked at as a bridge loan. I have loan officers all the time calling me and saying, hey, I'm trying to fix this borrower's credit. It's going to take a year to get it fixed. I can be able to put them into a conventional loan in 1 year, but I need to help them repair their credit, where there's a lot of loan officers helping their borrowers repair their credit. So a hard money is a great tool to help them bridge that gap between the time that they go, okay, right now they're sitting at a 540 FICO score, but by doing a few things to improve their credit score, I can get them up to 680. Now I can get them into a much more favorable conventional loan, and we'll refinance out of that hard money loan into a conventional loan within a year or so. So if the borrower does what the loan officer is telling them to do as far as doing the repair of the credit. So that's how sometimes the term bridge loan is used for in hard money world, is to help them bridge that credit gap issue. So to go back to what you're saying again, you're saying, go ahead, John, I'm sorry.
No, also exit strategy. That's the other thing that's part of a hard money loan.
Yeah. And it's can be, just getting them out of it, and putting them into a lot of our borrowers are actually, they're selling their properties. They're not keeping them for longer than 2 years. So,
Yeah, but that's one of the important things that a lender wants to know up front is what is your exit strategy?
yeah,
What is it that, you're going to be, when you get in the loan, what are you going to do when you try to get out of the loan too?
yeah.
How long is that investor going to be in that loan? That's one of the things they want to know. So.
True, correct. And we do too, but generally we're going, everything changes, from day to day. They could say, okay, I'm planning to do this, but that may or may not happen,
Right.
So, you could have somebody unfortunately pass away, and now you're dealing with probate, and you're dealing with who's inherited that property and getting them in to pay off the loan as well. So,
Okay, well, that was great.
That's a different exit strategy.
Uh,
That's an
Sold.
extreme exit strategy.
Well, Alan, that was great. Great presentation. Great information on private money loans. If anybody out there has any other questions, please hit us up. This was really just the background of it. As you can see, Alan has a wealth of knowledge. He's seen a lot of different properties, met a lot of people, and so he's got a great background in this. And certainly, will be willing to take your questions on this. Anything else? Anybody else?
What I found, what I've enjoyed about the business is meeting the people that are my clients, meeting all the real estate agents and all the loan officers doing this type of business as well, but also visiting these properties all the time and seeing what people are doing and what their dreams are. So I try to help them with their dreams. So
yeah, that's great. That's great. Well, thanks again. Thanks again for watching our Private Money podcast. Hopefully you learned something, and we'll see you on the next one. Thanks.
all right, take care, guys.
Okay. If you guys